Silver isn't scarce. It's gone. Not in theory. Not in 5 years. Right now. The exchange that sets the global price can't deliver the metal it promises, and the people who know this have been preparing while you were told nothing was wrong. Pull up your phone right now. Search COMEX registered silver inventory. Don't scroll past it. Look at the number. Registered. Not eligible. Registered. That is the silver available for delivery against contracts. Today, that number is hovering around 30 million ounces. 30 million. That's less than 1 ounce per American. Think about that for a second. Now here's the part most people miss. COMEX doesn't trade silver. It trades promises. Paper contracts. For every single ounce of registered silver, there are hundreds of ounces of paper claims. Some estimates say 300 to 1. Others say more. Either way, the math is broken. Here's what they're not telling you. This wasn't an accident. This didn't happen overnight. This was a slow, quiet drain that started years ago, while headlines distracted you with price charts that went nowhere. Go back to 2015. COMEX registered silver was over 150 million ounces. That's a real buffer. That's a system that can handle stress. Now move to 2020. After the lockdowns and stimulus, registered silver fell to around 80 million ounces, almost half gone. But nobody panicked. The price was still controlled. The paper market still worked. Now jump to 2024. Registered silver slid under 40 million ounces. That's not a rounding error. That's a collapse. From 150 million to under 40 million. That's a 75% drop. And today, it's flirting with 30 million. That's the lowest level in modern COMEX history. And here's where it gets interesting. While inventories were draining, one bank kept showing up on the other side of the trade. JP Morgan. Year after year, month after month, they took delivery. They moved metal out of the system. Public records show JP Morgan accumulated over 1 billion ounces of physical silver over the last decade and a half through COMEX and off-exchange channels. 1 billion ounces. That's more silver than most central banks hold gold. They were stacking. You were watching price charts. Do you understand what this means? When metal leaves registered inventory, it's no longer available to settle contracts. The system only works if most people never ask for delivery. As long as traders roll contracts and settle in cash, the illusion holds. But when too many people want the real thing, the game stops. Now look at demand. Industrial use alone consumes over 600 million ounces of silver every year. Solar panels, electronics, medical equipment. That silver gets used once, it doesn't come back. My supply? Around 800 million ounces a year, and it's flat. No surge, no miracle increase. At the same time, investment demand has exploded. In 2015, silver ETFs held about 600 million ounces. By 2020, that number crossed 900 million. By 2024, it pushed past 1 billion ounces. That's more than an entire year of global mine supply locked away. That's silver not coming back to COMEX. They were securing the supply. You were told silver is boring. Imagine you spent 10 years saving cash. Inflation cut its value in half. Your dollars stayed the same. Their dollars became metal, physical, unencumbered, out of the system. Now ask yourself this. If COMEX is so healthy, why is registered inventory at historic lows? Why are delivery times stretching? Why are premiums on coins and bars rising even when the paper price stalls? Paper silver says one thing. Physical silver says another. And that gap is the signal. Here's what they're not telling you. COMEX doesn't need to run out of silver to fail. It only needs to lose confidence. The moment enough participants doubt delivery, the price discovery mechanism breaks. At that point, the paper price becomes meaningless. China knows this. They've been quietly importing silver through Shanghai, locking it into state and industrial reserves. No noise, no press releases, just steady accumulation, because they understand something most Western investors don't. When systems break, physical holders set the terms. Think about the timeline. 2015, plenty of silver. 2020, inventories fell. 2024, inventories critical. Now, record paper volume trading against a shrinking physical base. That's leverage on top of leverage. That's stress. But wait, there's more. COMEX rules allow for cash settlement. That means if they can't deliver metal, they can offer dollars instead. At the paper price, not the real price. The price you see on the screen, not the price people are paying to actually get silver in hand. Do you really want to be paid in depreciating dollars when everyone else is demanding metal? This is why premiums matter. When a 1-ounce coin sells for $10 over spot, that's the market telling you something. When 1,000-ounce bars are delayed or redirected, that's the market screaming. They were preparing for a system failure. You were told the system is fine. And then between late 2023 and mid-2024, something happened that changed everything. That change was simple but deadly for the system. Large players stopped rolling contracts. They started demanding delivery. This is where the flip happened. For years, silver traders played paper games. Buy, sell, roll, settle in cash. But starting late 2023, delivery notices surged while registered inventory kept falling. The system assumed most people would never ask for metal. That assumption broke. Let me show you exactly why this matters. When someone stands for delivery on COMEX, the exchange must provide physical silver from registered stocks. Not promises, not future supply, real bars. But registered inventory was already near record lows, so every new delivery request hit a thinner and thinner base. Now here's where the money math gets brutal. JP Morgan reportedly controls over 1 billion ounces of silver across vaults and off-exchange holdings. Do the math. If silver moves just $1 higher, that's $1 billion in unrealized gains. Every $5 move, $5 billion. At $25 silver, that's one number. At $50 silver, that's a different world. Every single dollar up hurts short sellers and rewards physical holders. That's the flip. Here's what they're not telling you. COMEX is still setting the global price, but it's doing so with paper volume that dwarfs physical supply. On some days, over 1 billion ounces of silver trade on COMEX in one day. That's more than global mine supply for an entire year, traded as paper, against 30 million ounces of registered silver. Do you understand how unstable that is? Now here's where it gets interesting. Look at the delivery data from early 2024. March and May were heavy delivery months. Thousands of contracts stood for delivery. Instead of refilling the inventory, registered silver kept draining. Metal left the vaults. It didn't come back. At the same time, we started seeing something unusual. Paper prices stalled or dipped, but physical premiums rose. That's not normal. That's stress. Paper silver said $23 an ounce. Physical coins in the US sold for $30. That's a 30% premium. In Europe, premiums were even higher. In parts of Asia, bars traded well above paper prices. The paper says one thing. Reality says another. This is what system stress looks like. Now let's talk about the second pressure point. China. China isn't buying silver for speculation. They're buying it for industry and strategy. Solar alone consumes massive amounts of silver. Each solar panel uses silver paste. China installs more solar capacity every year than the rest of the world combined. In 2023, China added over 200 gigawatts of solar. That translated into hundreds of millions of ounces of silver demand. And that demand doesn't care about COMEX prices. Factories don't shut down because silver futures dip. They pay what they must to secure the supply. At the same time, governments are waking up to supply chain risk. Silver isn't just an investment metal anymore. It's a strategic material. Electronics, defense systems, medical tech, AI hardware. Once silver enters these pipelines, it's gone. So now you have a dual squeeze. On one side, investors are demanding physical delivery from COMEX. On the other side, industrial and state demand are pulling silver out of the global market. Both are draining the supply. Neither cares about paper pricing games. They were betting on endless liquidity. You were told, supply doesn't matter. Here's another red flag. COMEX eligible inventory still looks large on paper, over 250 million ounces. But eligible doesn't mean available. It means someone owns it and might sell, or might not. Registered is what matters, and the registered keeps shrinking. Imagine a bank with plenty of money in customer accounts, but no cash in the vault. On paper, it looks fine. In reality, it's fragile. Now look at history. In past silver squeezes, like 1980 or 2011, the market was smaller. Industrial demand was lower. Solar barely existed. EVs were science fiction. AI wasn't a thing. Today, silver demand is structural, not optional. Do you see why this time is different? Here's what they're not telling you. Cash settlement is not neutral. If COMEX forces cash settlement during a delivery crunch, confidence evaporates. Because everyone knows the paper price was fake. Once that trust is gone, price discovery moves elsewhere. To physical markets, to private contracts, to places where metal actually changes hands. That's when price gaps explode. The paper says $24. Physical trades at $35. That's a 45% premium. And premiums are the early warning system. They show stress before headlines do. They were positioned for delivery failure. You were positioned for price charts. Now you might be thinking, didn't someone try this before and fail? Didn't silver squeeze attempts blow up in the past? Let me show you why this is different. Yes, people tried before. And yes, they failed. But they failed for a very specific reason. They were early, and they were underpowered. Back then, silver squeezes were driven by speculators, retail traders, a few hedge funds, some loud headlines. They had paper contracts and borrowed money. When pressure hit, they folded. This time is different, because the players are different. They had leverage. These players have metal. They had short time frames. These players think in decades. They needed higher prices to survive. These players win even if the price stays flat because they already control supply. JP Morgan didn't build a billion-ounce position to flip it for a quick gain. China isn't importing silver to trade futures. Industrial buyers aren't hedging for fun. They are securing input that they cannot function without. That's the key difference. In 2011, global silver demand was about 900 million ounces. Solar demand was small. EV demand was tiny. AI hardware demand didn't exist. Today, total silver demand is over 1.2 billion ounces a year. Supply is under 1 billion. The gap is filled by inventories that are already depleted. Do you see the problem? Let's talk future demand, because this is where the math becomes impossible to ignore. First, solar. A single large solar farm uses millions of ounces of silver. Global solar installations are projected to double again by the end of the decade. Even with thriftier designs, solar alone could consume over 300 million ounces a year. That's more than a third of the annual mine supply. Second, electric vehicles. An EV uses 2 to 3 times more silver than a gas car. Charging infrastructure uses even more. Governments are mandating EV adoption. That demand is locked in by policy, not price. Third, AI and data centers. Every server, every chip, every high-speed connection uses silver. As AI expands, so does silver intensity. This demand didn't exist 10 years ago. Now it's accelerating. Fourth, military and medical. Silver is critical for guidance systems, satellites, and antimicrobial applications. These sectors do not substitute away from silver when prices rise. They pay whatever is required. Now ask yourself this: where does the extra silver come from? Mining isn't responding. Most silver is mined as a byproduct of copper, lead, and zinc. That means higher silver prices don't magically create more supply. New mines take a decade to develop, and grades are falling. They had a flexible supply. We have a rigid supply. Here's what you should watch next. First, the COMEX registered inventory. If it keeps falling, pressure is building. Second, delivery volumes during major contract months. High deliveries plus low inventory are a warning sign. Third, physical premiums. Premiums rising while spot stalls mean stress. Fourth, Shanghai silver prices versus COMEX. When Shanghai trades higher, physical demand is winning. Fifth, sudden rule changes or cash settlement language. That's what systems do right before they break. Here's what they're not telling you. Price explosions don't start with headlines. They start with quite shortages. They start with delivery delays. They start with premiums. By the time the price moves, positioning is already done. They were watching inventories. You were watching candles. Now let's talk about you, not hypothetically, not emotionally, logically. Imagine 10 years from now, silver is no longer priced by COMEX. Physical markets set the tone. The price isn't $20 or $30. It's whatever clears real supply and demand. You will fall into one of two groups. You will either say, I saw the inventories collapse, I saw the delivery stress, I saw the premiums, and I acted. Or you will say, I saw it, I understood it, and I did nothing. Both are choices. Both have consequences. This isn't about getting rich overnight. It's about not being last in line when the system admits it can't deliver. Because when that moment comes, price won't matter. Availability will. They were securing ounces. You were securing opinions. Think about that for a second. If this opened your eyes, share this video with one person who needs to see it. Subscribe to the channel, comment, wake up below. The rest is up to you.